The following podcast was recorded on Wednesday, February 14th, 2024, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com, or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Jim Bianco of Bianco Research. How are you, Jim?
I'm fine. Thanks for having me.
Today, Jim answers a question: is last mile the new transitory? Jim, Wall Street starts with the conclusion that we are in the last mile in the battle against inflation, and the economy is normalizing to its pre-pandemic levels. But what are they missing, and what is the last mile?
So let's start with the second part first. The last mile is a term that Wall Street coined to talk about the move of inflation from about 3-ish%. I'm going to use basically headline CPI unless I state otherwise, to 2%, which is where it was pre-pandemic. So that final 1% move down, remember that it peaked at 9% in June of 2022, is the last mile. That's the phrasing that they're using. And that's what they mean by it. And if we go to the chart, what I think they're missing is two things. First of all, let me go through the chart, that this is a classic case of nowcasting. What is nowcasting? Nowcasting is, actually John Stewart invented the term, and what he meant by it is take something that just happened, and then predict it's about to happen, as opposed to a forecast. And so this top panel here shows you inflation. And there you see in June of 22, it peaked at 9%, 9.1%. And then in June of 23, a year later, it bottomed at 3%. And we're 7 months past that, and we still have not gone below that 3% number. The bottom chart I got off my Bloomberg. They have a function called news trends where you could type in a phrase and it'll tell you how many news stories this phrase appears to. So I looked up last mile and inflation. So we were talking about the inflationary last mile. And really up until June, this term didn't exist. This term was invented in June of 23 to talk about the last move in inflation from 3 to 2%, 7 months ago. And we haven't been to 3% since they invented the term. So basically what I've joked was the last mile got completed in June, and then we invented the term last mile. And that's really where what I think it all means. Now, obviously, I'm kind of leading the witness here by saying that, the way I'm explaining it, that I'm not a fan of that. And I'll go to your first half of your question. What are they missing? Now, later on, we'll talk about some of the details of the employee inflation report, but I think the big picture they're missing, and if you read a lot of the commentary, even if you look at Janet Yellen the day we're recording, is out saying that the economy is returning to normal. Normal. All of this is, that thing that happened in 2020 when 14 million people lost their jobs, and we had to wear masks and we shut down the economy, we restarted it? It doesn't matter. That was a one-off thing and it's all over. And remember how the world worked before the pandemic? That's what they mean by normal, that we're going to go all the way back to 2019 and everything is going to be exactly like it was in 2019. No, it is not. We are in a new cycle. New does not mean worse or dystopian. Every time there's a financial event, 2008, 2001 with 9/11, 97 with the financial crisis of Asia, 87 crash, and 2020, coming out of those events, the economy changes and the cycle is a little different. This one is no different, but what everybody's telling us is, no, it isn't different. It is exactly like it used to be. We have remote work. We have deglobalization. We have global wars. We have supply chain constraints. We have a different attitude about spending. I hear a lot of people going, where is everybody getting the money about all this consumption that we've been seeing? Because they have a different attitude about it. That's where they're getting the money. They're willing to spend more aggressively. And we could touch on that later. So what is it that they're missing? This is a different cycle. They keep telling me how things worked in 2019 and how we're going to return to it. Janet Yellen just did an hour and a half ago. Last week, or now 2 weeks ago, excuse me, Jay Powell did at his press conference. So bigger picture, I think that that's what they're missing, that the economy has fundamentally changed. It is, and that those changes are perpetually keeping it a little bit out of balance, putting frictions in that are keeping prices higher. So we're going to have elevated inflation.
And Jim, what's driving inflation?
So I think there's three things driving inflation. We go to the next chart. Those three things are the base effect, gasoline prices, and owner's equivalent rent or shelter. Now, anybody that wants to go off and talk about pet supplies, yeah, some people were talking about that, or they want to start, talking about the price of haircuts. Yeah, there were some people that were talking about that, or used cars or airlines or any of that other stuff. You're getting caught in the minutia because you've started with a conclusion that we're on our last mile to 2%. So, hey, look at this. The price of haircuts went up, and that's why the inflation rate's elevated. Don't worry, we're still going back to 2%. But ultimately, there's three big drivers of the inflation rate. And I think all three of them are pointing at a bottoming in inflation, and that is going to be problematic. We'll talk about that in the last section, but let me talk about those three. The first one is the base effect. All that means is, what are we dropping from a year ago? So this chart is monthly CPI, headline CPI again. And in red, those three red bars are February, March, and April of 2023, a year ago. So we're at 3.1% inflation. When we get the February CPI report next month, we're going to drop 0.4 off the year-over-year calculation from February of 23. What are we going to replace it with? I'll talk about that in the next section. But then after February, March is 0.1, then another 0.4 in April, then 0.1, 0.2, 0.2. And that gets us all the way into the end of the summer. So after February, there is really only one big monthly CPI number. So the hurdle rate to jump over these numbers will be very small. So if we don't get a big decline in the February number versus February a year ago to bring down year-over-year inflation, I don't think we're going to see year-over-year inflation fall again until the fall. And that will be right on top of the election. So the base effect is really working in its favor to keep inflation elevated. Let's go to the next chart, and that is gasoline prices. Gasoline, it's 3.6% of the CPI basket, but it's incredibly volatile. So here's the national average of gasoline as published by AAA Motor Club. They do every morning. And you'll notice on the chart, this chart goes back to December, but notice that on February 6th, we were at 3.14 a gallon. And on February 13th, we are now at 3.25, rounded to 3.26 a gallon. We're up 12 cents in a week. Furthermore, if we go to the next chart, we are up about 2% in 2 days. Now, how does that work? So this chart here is my worksheet for figuring out gasoline's impact on the CPI number. Top panel in blue is just the gasoline price, but that's the monthly average. All the dailies averaged for the month. And the February number is all the dailies so far through the 13th, because we haven't gotten the 14th data yet. We're recording on the 14th. And the second panel in red and green shows you that the monthly average of gasoline prices are up 2.68% from January. The third panel in black shows you that the weighting that gasoline has in the CPI, it's currently 3.68%. It fluctuates with the price. When the price goes up, because gasoline is fairly inelastic, that's an economics term that means when I go to the store or go to the gas station to fill up, I fill up. If the price is up and I have to pay more for it, I grouse, but I still fill up my car. I don't say, well, I've only got so much money, so I'll put 15 gallons in the car and not go all the way. And that's why when price goes up, the weighting goes up. But if you take the monthly average change and multiply it by the weighting, you get the green line. And the green line shows you 0.09. That rounds to 1/10. Gasoline prices are going to add 1/10 to overall CPI for March through the 13th. Now, if they keep going up, it'll add more. If they peak and come down, it will start taking away from it. I'll point out that if you look at January and December, it subtracted 1/10, rounded down, and subtracted 2/10 from headline inflation in January and in December. So we've got a, in January, let me keep it this simple. Gasoline prices took 1/10 out of headline CPI, and it still came in at 3/10. In February, it's going to add 1/10, so a 2/10 swing. So it's not only going to not subtract 1/10, it's going to add 1/10, and we already printed 3/10 in January. So this is going to put upward pressure on the inflation rate. So if you look at the Cleveland Fed has a CPI nowcast, their guesstimate as to where inflation is going to be, and a big component of this is gasoline prices. They're estimating that gasoline is going to be 4/10 in February. Okay, we're going to drop a 4/10. We're going to add a 4/10, and the year over year will remain at 3.1. And then we'll go 8 months since we invented last mile that we haven't been lower than the day that we invented that term. And then the base effect gives us all of those low numbers that we could stay over 3% until the fall. Now, I'm assuming we don't see gasoline prices or crude oil prices, the big driver of gasoline, collapse to $50, or we have a financial crisis, or we have a shooting war, or something that you wake up one morning and go, uh-oh, that changes a lot of things. Now, when that happens, we'll have a podcast and we'll talk about it. But until that happens, what we're looking at, I think, between the base effect and gasoline is 3% GDPs all the way out. And that gets me to the third part. And the third part, the next chart, is owner's equivalent rent. So how does the BLS, the Consumer Price Index, calculate housing inflation? They do a survey of rentals, and they ask what the rental prices are, and then they put them into an algorithm to guesstimate your house, my house, every house in the country. If you rented it, how much would you get for rent? Even though some houses, would never be rented, they guesstimate it, and then they guesstimate what you would have gotten a year ago, and that's how they come up with housing inflation. And then they also do the same survey in a different algorithm that's somewhat similar for rental inflation. Now, 24.5% of CPI is housing inflation, and 7.8% of CPI is rental inflation. So the two of them together are 34% of CPI. They're a third of CPI, the single biggest factor. So rental inflation matters quite a bit. And what you'll see a lot of people talking about is a variation on this chart. The blue line and the orange line are the year-over-year changes in housing inflation. Owner's equivalent rent, that's inflation of homes. Rents of primary resident, that's inflation of rental units. They are somewhere at around 6.1-ish% on a year-over-year basis, way above the 3.1 that we see in overall inflation. Now, all the thin lines in the chart are real-time measures of rentals. So it's the apartment.com list of what is the average rental price in the United States, Zillow rent index in red, and the Case-Shiller home price index in green. Rentals, the BLS recognizes rental units don't really change their prices that much. So they've got hundreds, if not 1,000 or so rentals. We don't know how many because they have to sign a non-disclosure agreement, so it's not really known who they are. And I like to joke because if we did know who the rentals were, Goldman Sachs would buy them all and then they could set the CPI wherever they wanted to. So they keep that a secret. And so what we do know is that they survey them once every 6 months because rentals don't move that much. So OER and RPR tend to be very slow moving. So people are looking at this and then they're looking at the year-over-year change in apartments.com, Zillow, Case-Shiller, and going, well, all the real-time measures fell a lot. So housing inflation is going to fall a lot. And what happened in January is it went from December's 4/10 for the monthly rise to a 6/10, both of them did, in a monthly rise in January to one of the highest numbers in a year. And we said, oh, that's wrong, it has to be coming down. And I've argued this chart, or a variation in this chart, which is extraordinarily popular on Wall Street. Cam Harvey of Duke University, the guy that invented the yield curve as a recession indicator, is using a variation of this chart. Claudia Somm has an FT op-ed the day we're recording. She's not using the chart, but describing a variation in this chart. I think that this is the wrong measure. So if we go to the next chart shows you where I think is the better measure. It's the same measures, same indicators, but now I look at the cumulative change since 2015. And the red line and the green line, I'll start with those, is Case-Shiller and Zillow. Apartment list didn't start till 2017. That's why it's not on the list. It didn't exist in 2015. And you'll see the red line, it follows the blue and orange lines closely. So the cumulative increase in OER and RPR and the cumulative increase in Zillow were very, very close. And home prices, as measured by Case-Shiller in green, sort of kind of tracked it. It was a little, home prices ran a little hotter, but it sort of kind of tracked it. Then in early 21 and into 22 and 23, rentals took off and Case-Shiller took off, but OER and RPR never showed the same increase. So what I'm arguing here is OER and RPR understated inflation's gains over the last couple of years. And there has to be some catch up. So if we could go backwards a chart, back to the older chart, what I'm arguing is, you see all those big mountains on those Case-Shiller, apartment.com, and Zillow up to around 16 or 18% in early 23. OER and RPR never reflected those giant gains. So does that mean they have to go up? No. But I think what they're going to do is not come down as fast. So if we go back to the next chart again, that gap between the blue line and the orange line and the red line and the green line will close, because OER and RPR will rise faster than those other ones and eventually close that gap, which is a nice way of saying a third of CPI is going to stay sticky. Add it all up, and what you're looking at is, with the rise in gasoline prices through the middle of February, unless there's something dramatic, we're going to print 3 handles on headline CPI, year-over-year CPI, all the way to the fall, is where I think we're going to go with this. And that this is something most people that are talking about a last mile are really not ready for.
And how will markets take it?
Not well is the answer, is the summary answer. So if you look at the next chart, it shows the 10-year yield, and it shows you an 8-day change. Now, there's a specific reason I picked 8 days. That covers from the day before the payroll report. Remember that it was this monstrous blowout. That's 8 trading days, by the way, not actual days. So that was that monstrous 335,000 job number that surprised everybody in the big upward revision to December, all the way through February 13th beat on CPI, 0.4 on core, 0.3 on headline, and the big surprising beat on super core as well. Over those 8 days, we saw the yield on the 10-year rise 44 basis points. That is the biggest 8-day rise we've seen in a year and a half. So between the strong economy and the inflation, the market is sending you a signal. I believe this is real. This is problematic that we're seeing right now in what we're seeing with the data. It's too strong, and the inflation data is too hot. So if we go to the next chart, the Fed is going to have to change their opinion. So this is a forward-looking curve of the futures contracts. What is the market pricing in over the next year? The blue line on the chart is something I created. What is the Fed communicating? They said that they give us that dot chart. The dot chart says that at the end of 24, there will be 3 rate cuts. Okay, we don't know when. So I just kind of put them kind of like 1/3, 2/3, 3/3 in the middle of the year in order to just say, okay, the Fed says they're going to cut rates 3 times. The green line on the chart is where the market was pricing things on February 1st, the day before that 8-day rise, the day before the payroll report. It was saying that we're going to get 6 rate cuts, not 3 rate cuts, by the end of the year. And the red line is the day of CPI, or in the case we're recording, yesterday's close. That went from 6 rate cuts at the end of the year to 3. So those two numbers, payroll strong, CPI strong, took 3 rate cuts out of the market, took us from 6 back to 3. So it did have a big impact on the thinking in the marketplace. Bottom line is this data is too strong, and the inflation data is staying too sticky at around 3%. And I think it's going to stay at around 3%. And what you're going to see is all the talk of rate cuts, if it stays that way, I think is going to be kind of what we've seen over the last 2 years. The rate cut will be in 90 days. And then in 90 days, they'll say the rate cut will be in 90 days. And then 90 days after that, they'll say the rate cut will be in 90 days. It will never materialize. It will just perpetually get pushed off and off until the inflation data comes down, or maybe I'm wrong on the inflation data because it is a forecast, or the economy takes a serious turn lower, or the something we wake up one day to screaming red headlines that something happened, financial markets, oil, geopolitics. We have a new set of candidates for the November election, any or all of the above, and you go, uh-oh, gotta go back to the drawing board and redesign this outlook because now it's changed. So until that happens, what we're looking at is we're going to perpetually be taking these rate cuts out because this data is too strong. Can we go the other way and actually go to rate hikes? It's my final thought for you. The Reserve Bank of New Zealand is their central bank. Now, it's a small country, but it is a developed country. They have an official cash rate, which follows, that's their benchmark rate, which is like the federal funds rate in the United States. It's very, very similar, their economy to our economy. They have been a very forward-looking central bank over the last many years. They invented inflation targeting in 1989. The Fed adopted it in 2012, 23 years later. They were the first central bank, I'm talking about developed world central banks, to raise rates in early 21. They were the first developed central bank to pause in early 23. They lead. What has been coming out of New Zealand in the last couple of weeks? It's very simple. Inflation is not yet under control, and they're looking at raising rates 2 more times. Their official cash rate's at 5.5%, just like the funds rate's at 5.5%, and they're looking to raise their official cash rate twice by summer to 6% because inflation is still a problem. It doesn't mean we will, but I will just leave it with you that central bank that leads all the other ones is reversing and starting to talk about more rate hikes. And why? Because inflation is problematic. Why do I think inflation remains problematic? Because 2020 had a gigantic effect on the economy. It changed working patterns because of remote work. It accelerated deglobalization. And coming out of 2020, I think the thing, and I'm hopefully going to, develop this theme out over the next couple of weeks, is that we don't appreciate that consumption patterns have changed. That's a fancy way of saying we just spend more money now, and we don't worry as much about things. In 2008, when we had the financial crisis, by 2011, 2012, the stock market recovered, and it was going up. And I'll keep the example simple. You got your brokerage statement, and you saw that you made money that month. And you looked at your Zillow estimate of your house, and you saw that it was worth more. What did you do about it? Nothing. You felt better. My net worth, my savings increased. My cushion against something bad went up. That was good enough. But in early 2020 or late 2020, early 2021, excuse me, when we were mailing out stimulus checks and the stock market was recovering, first thing we started to notice was what people were doing with that money. They were spending it. We invented the word revenge travel. They were buying meme stocks. They were wildly speculating on GameStop and options and everything else. They weren't plowing that money into treasury bills saying, thank God I've got this nest egg in case something bad happens. No, they were gambling, and we invented the phrase revenge travel because we were going to go out, we were going to live our life. So I think after the 08, we had this introspection that we wanted to keep money. and we wanted to keep wealth, and we wanted to have a nest egg for a rainy day. But coming out of 2020, where maybe it was PTSD from the shutdown restart or whatever it was, but consumption and spending patterns are much higher than we think. They're just living differently. They're spending more aggressively. David Kelly, JP Morgan economist, is saying they can't keep this up. What are they going to do? Be broke at 62? That's exactly the phrase that he used in a presentation earlier this week. And the answer is they're not thinking the 62. They're thinking about, I am going to enjoy my life. I am going to go on this vacation. I'm going to buy that new car. I am going to get a new iPhone, or whatever it is that you want to do. And I will worry about 62 when I'm 61. It is a change of attitude. So what the mistake economists are making is, well, we've got this much income and this much savings, and these were the rules in 2019. Stop there. We have a new set of rules. And the new set of rules is consumption patterns are far more aggressive now coming out of that. Maybe there's a moral hazard in there. Well, the government mailed me checks, and when things go bad the next time, they'll just mail me more money. So I might as well just enjoy my life, and when things go bad, they'll just mail me more money. And then if they don't mail me money, the Federal Reserve will do whatever it needs to do to push the stock market up. So when the stock market crashes, I'll just plow everything that I've got left into it and then wait for Jay Powell to levitate it, and then I'll make some money. Let's go on vacation. Let's buy a new car. Let's not worry about 62. And that's kind of the attitude we have, which is why the economy's doing better. That's spending. It's a different attitude. It's keeping inflation sticky. But what most economists are stuck with is nothing changed. Everything's normalizing. And we're looking to where we're going to get back to 2019 when we had 2% inflation. We don't ever get there. And if we don't get there, I don't think we're going to see rate cuts. And I think we're going to see higher interest rates.
Jim, thank you for your thoughts today, and thank you everyone for joining us. If you have any questions on Arbor Research, Bianco Research, or Arbor Data Science, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks again. Have a great day.